So hello there, I'm Liz Dysart with the Crawford team at VIP Mortgage, and thank you so much for joining us today for this lending update on April 21st. We have been doing these every week to really help our agent partners understand what's going on with all of the lending changes through COVID-19. The first really 3 weeks of this situation, there was daily changes, and we were having mandatory staff meetings every single morning so that we were really aware of what was going on in the industry so that we could keep up on it and make sure that our deals were closing on time and educate our agent partners. So now we're 5 weeks in and things are starting to normalize a little, but there are definitely some things we think agents need to know in order to help them effectively close deals and educate their clients. So we'll go ahead and get started on what those are. If you're not familiar with my team, I work with the Crawford team at VIP Mortgage. We were a top 200 lender in the United States for 2019 by Mortgage Executive magazine. That's based upon volume. So we're super proud to do high volume with a small team, but we're really customer service obsessed. So that's what we care about most. We provide a great client experience both for our buyers and our agent partners. So if you don't have a lender partner, we would love to be an option for your clients. And today, kind of what I'm going to go over is a state of the union on the lending world, kind of where we're at and where we've been through this COVID-19 crisis. We're going to talk about some of the headlines that we have seen in the media about lending over the past few weeks and how some of them really incite some fear, which is unfortunate. So we're going to kind of talk about what those mean. We're also going to talk about the product and program changes, which I think are the most important for agents to know of all of the things probably we're going to talk about today. But you know, those will give you what you need to know, but not all the details you don't need to know. And then we're going to talk about changes to verifications and appraisals that we've seen through this process, and then where we think lending is headed. So let's dive right in. Here are some of the headlines that we have seen over the past couple weeks, and some of these are a little bit negative and incite fear. So we hate when they put things out without a lot of explanation because it does make people a little panicked. So the first one says it may be harder to get a mortgage after coronavirus crisis ends, Calabria says. So Mark Calabria is director of the FHFA, and he basically has some concerns about the changes lasting longer, and basically all of the banking industry becoming more conservative due to some of the uncertainty in the financial markets. So that's one we'll talk about through this presentation. But that's a hard thing to read, that headline, and it really isn't fair. It doesn't apply to all borrowers. So we'll talk about what is a better statement later on. The next headline, lenders get stricter as some borrowers think they don't have to pay. And what they're meaning with that is that some borrowers are thinking they don't have to pay their mortgage. There's a lot of misinformation in the marketplace about that. So we're going to discuss that as well. And the third one was a big announcement made by Chase, which is one of the largest mortgage servicers in the country. They now require a 700 FICO score and 20% down payment for all purchases. So that was a significant, change to what their previous requirements were for purchases. That's a lot more conservative, which tells us that they're probably trying to minimize or I guess slow down the rate of loans that they're doing during this time to minimize their risk. So we'll talk about that as well. But really, where we're at right now is we have seen a tumultuous month of rates with loans. And the first week, about March 5th, they dropped really fast to, the really low threes. And that was the lowest that we had seen in years. And then almost as quick, within about 5 days, they jumped up 3/4 of a point, which, in all of history, there's only a few times that that's happened. And then they continued to bounce around a little bit until now they've seemed to have stabilized a little bit more. But we wanted to put this chart here because if you look over the last 3 years, 2018 national 30-year average for a 30-year fixed was 4.4, March of 2019, 4.27, and this March, 3.3. So a significant difference. And the reason why rates were jumping around so much is because when they dropped so low, it opened up a huge refi boom. And everyone was wanting to refi because it was a great time for them to save a lot of money on their payment or get a better loan type. And every lending institution got bombarded with mortgage inquiries about refis. So what that did is it put a lot of strain on the system, right? Even, inspections and appraisals and all those type of things. All of the third-party companies that we rely on to close transactions got bombarded as well. So timelines were getting delayed. But what we were seeing is, in an effort to really minimize continued, insane volume, what was happening is all these lending institutions were raising their rates temporarily to ward off future business so that they could kind of clear their pipeline that they had, manage the chaos a little bit better, and then rates would change again once they were ready to start accepting more locks. So we were seeing rates really jump all over the place, even hourly, which was pretty nuts. And a lot of that was due to the big word that's now a buzzword, forbearance. So there's been a lot of confusion on what that is. And we're going to talk a little bit about that right now. But forbearance is basically the ability to skip mortgage payments. However, it does not mean that you don't have to pay. All of them come with some sort of stipulation of how they're going to be paid back. So what forbearance is it's always existed, but it's never existed to this level. It's when somebody has some sort of financial crisis or health crisis, they contact their mortgage servicer and they get a temporary relief or reprieve from paying their mortgage. Each servicer has the ability to decide what the terms of the repayment are going to be. And we've never seen it in history in these kind of levels as we have with COVID-19. The FHFA, Mark Calabria, director, he said, or was estimating that 1 million Americans would take advantage of forbearance due to COVID. He thought that would be by May. Right now, we're halfway through April, and the numbers already show that almost 3 million mortgages are now in forbearance. And one of the nation's largest servicers says that they're getting 20,000 forbearance inquiries a day, which is pretty unbelievable. But what they're doing is that it's on the honor system. They're not really requiring proof that people have lost their jobs or are really in any sort of economic hardship, had their hours cut, or even that they've been affected with the virus physically. So it's kind of this trust, right, that they're giving to consumers and allowing a lot of people to take advantage of this, which we need to give options for homeowners if they're having challenges paying their mortgage so they don't result in default. But there are some serious concerns about what this is going to do to the housing market if this many people keep continuing to request forbearance. So right now, as I said, there's about 3 million in forbearance, and that represents 5.5% of all active mortgages. And I think we're going to continue to see those numbers go up as this crisis clears. But as I said, each servicer has the ability to determine what their repayment plans are. And the scary thing is that a lot of servicers are requiring them as a lump sum repayment, meaning if they allow you to skip your mortgage payment for 3 months, on the 4th month, your normal rent or your normal mortgage is due, plus the 3 months that you missed in one lump sum. And that presents a huge problem for a lot of consumers, as if they're not able to pay 1 month's mortgage, how are they all of a sudden going to be able to come up with a lump sum of multiple months mortgage payment? So that obviously isn't a great option for people, but in the meantime, people are taking it because they don't have any other options. And what that could cause is people having to default when that lump sum does come due. Other servicers are allowing them to tack on those as additional months at the end of their term. And then others are breaking it up and kind of amortizing it over the life of the loan. So if your clients or anybody that you know has questions about this, what we encourage you to do is not guide them. We don't even think it's our job as loan officers to guide them. They need to contact their servicer and see what their options are. We also have some great resources that I'll provide to you guys that the CFPB has put out guiding American homeowners on what their options are. And those are very great resources for people to understand. It has all sorts of information, and it directs them to the appropriate channels if they want to explore it further. So I'll provide those to you guys at the end of the class. And if anybody has any questions on forbearance, feel free to chat it in as well. Now, the next topic I want to talk about is rates. Now, as I touched on, the rate market has been extremely volatile over the past 5 weeks. As I said, there was like almost a 3/4 of a point swing within a 5-day period at the beginning of March, which is something that we don't see very often. But now that they've normalized, the last week data from Freddie Mac indicated that the average 30-year fixed loan nationally fell to 3.31. So that's an amazing rate. As you can see, that's the lowest that it's been in the last 3 years. And it's a huge win for homeownership. And what we're thrilled about is that it'll hopefully keep a lot of buyers in the market, because demand has softened a little bit, especially locally. Some buyers have pulled out of the market due to just kind of wanting to wait this out. But for the serious buyers who do have a real need to buy right now, not only do they have less competition than they did before the coronavirus crisis, rates are lower. So it's really a phenomenal time for home buyers. So we encourage you guys to educate your clients that even though this is going on, they might be in an even better position to buy now than they were when this all started. So we're very hopeful that that continues and that the rates stay low, which they are expected to for the next several months, to really allow more buyers to enter the market and help us all close deals. Now, on the refinance side, as I mentioned, we saw a huge refi boom because rates were so low. And that caused a lot of banking institutions to have record months in the month of March, which is crazy. We're in a, world crisis here situation, and mortgage companies are busier than they've ever been. But that was primarily due to refis. So I'd say most companies have seen purchase volume decline a little bit, but hopefully with rates staying low, we shouldn't see too much of a decline over the next few months, especially as we are in selling season. The next thing I'm going to touch on quickly is all the product and program changes. And this is where I'm so glad that you guys are on the call, because there has been so much misinformation regarding these. And what's happening is really there's been this game of telephone that's happened with regards to product and program changes in the industry. A lot of people may not understand how this works, but a lot of the mortgage companies like VIP Mortgage, who actually originate the loans, then go ahead and sell the loans to another bank, right? So we sell a lot of loans to Chase and Wells Fargo and other mortgage servicers who purchase the loans and then resell them as mortgage-backed securities. But what's happened is a lot of the kind of changes that you're hearing are coming from the mortgage companies. So they're not necessarily global industry-wide changes. They're just changes that the mortgage companies have made to minimize risk to their own house, right, during this time. So these changes that I'm going to tell you about are not specific to VIP Mortgage. I'm going to talk in kind of generalizations about what we're seeing industry-wide, and I'll give you some specific examples of what some of the larger banks are doing. So the main change that we've seen to FHA and VA programs, which we call government programs, is that the majority of mortgage companies are now requiring at least a 640 credit score for these. Now, this is a big change. Before, a lot of mortgage companies, including us, were able to do these down to a 580 credit score. But because these generally require a lower down payment and less reserves, these are quote unquote higher risk loans for lenders due to the traditionally higher rate of default on these loans. So a lot of lenders, in an effort to minimize risk, are saying we're only going to offer these to well-qualified borrowers in regards to credit score. So they've kind of made more conservative requirements regarding those programs, and most, again, are only doing them for 640 or above. We've seen a lot of changes to jumbo programs. Pretty much all across the board, every lender has tightened up their qualification options really for those. So our most popular program for jumbo up until this point was a 10% down product. That's what a lot of borrowers wanted, was a 10% down jumbo product. Those pretty much don't exist anymore. The majority of the jumbo products out there are 20% down, and we've seen additional higher credit score requirements and higher reserve requirements, meaning that in addition to the down payment that they have to pay, they have to show that they have 6 months up to 12 months of reserves of that mortgage payment in the bank so that they can cover it in the case that they ever lost their income. Meaning if their mortgage payment is $5,000 a month and they have to have 12 months reserves in the bank, they have to have an additional 60 grand in the bank in addition to whatever their down payment is. So we have seen some changes with that. However, we are able to structure some more creative options for those people that are still wanting the 10% down jumbo product. What we're doing as a workaround is we're doing a 10% down product. It's a 20% down product. They're putting 10% down payment, and we're doing the other 10% as a second on the property. So there still are creative options for people wanting those. But for the most part, 20% down is now required for standard jumbo programs, with additional tightening up on credit score and reserves. Now, non-QM, QM stands for qualified mortgage, and these are kind of the specialty portfolio or niche products. So these are definitely not the most common products. These are the products that we do when the consumer doesn't fit into the standard buy box of loans, meaning maybe they are self-employed borrowers that doesn't have the income requirements we need, but they have assets. So then we can use a bank statement program. Or them they're 2 years out of foreclosure. Standard, you need 7 years for a conventional loan, but there are specialty programs that make them available to purchase within a day after foreclosure at a higher interest rate. Those specialty products are basically all gone for the time being. So I don't know when we'll see those back, but probably not for the near future. Down payment assistance or DPA loans, I'd say these were the most confusing of all. So all lenders nationwide get these from the same aggregator. There's one place that we all go to get these. That's why every lender has the same rate for DPAs. It's because they're set by the issuing agency. So the confusion with this is that the issuing agencies did not say we're not doing DPAs. They're still available. However, the individual lenders, the companies, have made choices to stop doing DPAs temporarily, again, in an effort to minimize risk to the company. And DPAs, kind of like some of the government FHA VA programs, are riskier products because generally those borrowers have lower credit scores, less money in the bank. If they don't have money for a down payment, it's unlikely that they would have a lot of reserves. So those traditionally have a higher rate of default as well. And so what happens is lenders, if we did a DPA and then that consumer didn't make their first month's mortgage payment, we could be required to buy that back from the loan servicer that we sold it to. So that's very risky for mortgage companies because the proposition of them having to buy back bad loans is very risky. So a lot of lenders have stopped doing these temporarily in an effort to really keep their risk down. Now, what we've done is we're still doing these, but it is on a case-by-case basis, and we are more conservative with what we're requiring for those. We definitely want those programs to be available for consumers that need the help with down payment, but we are cautious of the actual risk involved. And then lastly, for standard purchases, it's still business as usual. However, Chase and Wells Fargo both came out with really big announcements that I thought were important to mention. So Chase last week announced, they did this for jumbo about 3 weeks ago, that it was now jumbo purchases required 700 credit score and 20% down. Last week, they went to all purchases at Chase now are 20% down, 700 FICO is required. So that is much more difficult. And unfortunately, that does take some consumers out of the options for that program. Also, what they're doing, and that's on the wholesale side, meaning VIP Mortgage or Fairway or all the other mortgage companies who sell to Chase. Chase won't buy those loans from us if the consumers don't have the 700 credit score and 20% down payment. So, and then Wells Fargo has made some as well. Theirs was on the wholesale side, but similar changes. Both of those companies, we're seeing them get tighter on what they're requiring for qualification. So that's really it on the product and program changes. If anyone has questions, feel free to put it in the chat or we can address it at the end, but I'll keep moving on. Verification. So this has been a bit of a challenge through coronavirus. So typically when the underwriter requires a verification of employment, here's the form from Fannie Mae, the standard form that we have to fill out, basically, you know, verifying the borrower's employment, income, and all of that. In addition, in order to close, right prior to close, we have to do a verbal verification of employment, which means we literally have somebody who all day long, they call the business and say, hello, so-and-so, does Sally Smith still work there? Yes, great. And she has to check the box in the file that she did the verbal verification of employment, and then the loan gets to be funded. As a lot of businesses have closed during this, it's been a lot tougher to get verbal verifications of employment. Everyone's working from home. HR departments are obviously overloaded right now. So it was very difficult to get people to answer those phone calls. So instead of not funding the loans, we had to find some workarounds. So what the workarounds are is that we can now accept an email from a company email address showing the title, you know, the name and title of whoever is verifying the employment. We also are able to accept a recent pay stub within 2 weeks showing a direct deposit from the company's payroll. So there's some workarounds. That way we're not delaying funding due to not being able to contact the employer of the borrower. So that's great. So we're still, you know, able to process those pretty quickly. And then the last thing is tax transcripts. And most people don't even really know what these are or why we need them. But basically, when somebody submits a copy of their tax return for their file, the lender has to verify that it's correct and that it's not, hasn't been manipulated in any way. So what we do is we go to the government's website, IRS tax transcript website, and we pull it's a shortened, condensed version of their tax return that just shows the numbers, basically. And we verify that those numbers match the numbers that the borrower provided us with their tax return. What happened during all this is the government said, we're too busy. We're not providing tax transcripts. So that was a challenge, right? Because we're not able to verify those. So what we as a company decided to do was, as long as the file looked clean, there really wasn't any other issues, we're still funding the loans without tax transcripts. And I think that's what a lot of companies are doing temporarily. And that's, again, that's for the borrower. We don't want to hold up purchases because of, you know, the government being overloaded currently. So that's what we're doing in the meantime with tax transcripts. Now, the magic question we always hear is, where is lending headed? Where do we think it's headed? Now, we saw, I'm going to scroll back, some of these kind of doom and gloom headlines that it's going to be harder to get a mortgage. I think, you know, we'll still have to wait and see what's going to happen. I think it'll depend when we're allowed to get back to work, how the financial markets recover once consumer spending is back to normal, and really what our unemployment numbers look like a little bit too. But we really do believe that most of these lending changes will be temporary and things should normalize when we see recovery in the financial markets. And why we really believe that is because we were in a very strong financial position prior to this crisis. Our banking system isn't built on toxic debt or bad loans like it was in, you know, the previous crashes. We're really not seeing that. Rates are in a great spot. Unemployment was in a great spot. And overall inflation was at a good spot too. So we really think that while lenders have tightened up their requirements to be more conservative for the short term, we do think that things will loosen up a little bit once things go back to normal. The question is, when is that going to be? And we don't know. One thing that we do look at that I wanted to mention is the Mortgage Credit Availability Index. And this is the chart that you see on the left. As you'll see, it basically plummeted in 1 week. So This shows how available mortgage credit is to the average consumer. And as you'll see here, Mortgage Bankers of America publishes this index, and in 1 week, it took a decline of 16%. You'll see historically, there really hasn't been any drop nearly that big. And why that was is because all of those products all of a sudden were gone from the market. Now, if you read though, it's not as bad as it sounds, because if you look at the breakdown, 37% of those were jumbo programs, or the niche products, the non-QM products that we talked about, those portfolio loans that the average consumer is not getting. And only 2.7% were to standard non-jumbo loans. So while a lot of those niche products did go away, so it looked like the overall amount of products is significantly less, for the standard average consumer, they may not even notice some of those products were gone. And the other thing is that the amount of turmoil and change, it was like for a while there, everything was changing every day. We were hearing new announcements of things changing to products and programs. That has slowed down over the last week or so. So we really do think that on the product and program side, things are stabilizing a little bit, at least for today. Now, I have to give the disclaimer, this could all change tomorrow, and there could be some big announcement that came out. But right now, it does seem that rates are stabilizing. We are still seeing, record business as far as from most mortgage companies are having record months due to refinance volume and purchase volume still. So we don't think that it's all doom and gloom. We do feel that there will be, good things to come. And we do think that the future of lending, it should not be significantly harder for the average to consumer to get a loan after this is all over. Things should go back to normal because we were in a very healthy financial position. So that's kind of our outlook on that. So that's good news. Now, some resources that we can provide to you guys. Obviously, we can be a resource to you for all lending changes and updates. We do a class like this once a week, so you can always feel free to tune into the latest updates. The CFPB guide to coronavirus mortgage relief options, we're going to provide that to you in a link following today's class. The Crawford report, we really believe is an amazing resource for you guys. We sponsored a class that Tina Tambor taught last week, and really it's not all doom and gloom, although we have seen demand decrease since this all started locally. We really have not seen prices decrease much. So that's a very great thing for kind of the stability of our local housing market. Another thing that we can provide to you is a synopsis of the CARES Act that was passed and what that entails for the average consumer, and also options for business owners like the PPP loans and some of the other small business loans that are available to help people during this time when they are having financial impacts on their business. Other suggestions we have for you guys are, as leaders in our industry, we really feel like it is our job to be proactive with our clients through this. So communicate proactively. Don't wait for people to reach out and ask you questions. Inform through emails, text, social media. Be present and relevant to your clients more than ever. Be compassionate and considerate through this time. So keep in mind that a lot of people have dealt with a lot through this. Some people are experiencing major hardship, illness, and a lot of people are dealing with anxiety and stress concerning their financial situation or just the overall economic situation of our country. So make sure that when you are talking to people, you are being authentic and considerate and kind, because you never know who needs a little extra support that day. Focus on the positive. This is going to pass, and we have to say that we are very optimistic about what life is going to look like after this, because I think that helps kind of that doom and gloom talk. And then also share what you or your company are doing to help during this time, because I think that's something that brings a lot of positivity to people. Now I'm going to open it up to questions for you guys if you have any. So feel free to unmute yourself or type into chat. I also will be sending a email with this information following this, so you'll get a little recap. So yeah, feel free to chime in if you have questions. Otherwise, I very much appreciate you logging in today. I hope that it was helpful and gave you some insight on what's going on in the lending world. and that everything is great. We're still closing deals just like normal on our end. And we're here to help you guys close transactions with your clients as well. So we're always here to be a resource for you. Feel free to reach out anytime you have questions. Our contact information is at the bottom there. So feel free to let us know if we can ever help you. And now I will open it up for questions.
Liz,
So feel free to chime in.
So Liz, it's Patrick McIver. I had a quick question for you.
Sure.
With the new presidential decrees, I don't know what they're calling them right now, where they're saying, you know, they're going to cut off the borders right now. Do you think that's going to affect anything market-wise?
It's tough to tell. Yes, I think it will affect the financial markets, absolutely. However, the major changes to the financial markets don't directly affect mortgage rates. So there's a lot of misconception regarding that. But what we saw, the Fed cut rates to 0, and we had so many inquiries about, our mortgage rates down. They really didn't change that much, right, because of that. So they are correlated, but not always directly correlated. So I would expect definitely some changes in the financial markets, Wall Street, stocks and bonds. I'm sure that those typically, change due to political stuff a lot more than mortgage rates, if that makes sense. We kind of look at it as mortgage rates are more of a slow moving tanker. They don't fly up and down as quickly as the financial markets. So hopefully it will not affect mortgage rates.
And yeah, that was basically my question. The stock market's crazy. So
yes, it is. It's been very volatile. And I think what's affected mortgage rates more is the volatility and the consumer confidence, right? Because if consumers are scared and all of these investors are pulling out of the housing market, like we've seen with all the iBuyers, that affects rates more than, I would say, any sort of political announcement, depending on what it is. But really, it's been pretty crazy because initially, like I said, in that first week of March, rates were just jumping like crazy, mortgage rates. But we've really seen them stabilize and normalize a lot, even with the changes that have gone on in the past couple of weeks with the president's announcement to kind of launch the reopening in phases. So we'll have to watch and see. But yes, hope that answered. Any other questions?
Thank you.
All right. Well, thank you. I appreciate you guys joining me and always here. So reach out if you need anything. I hope you're all doing well. Have a great day.
Besides my 4 and 2-year-olds.
Oh, I get it. We have 5 kids at home, so I can relate. Have a great day.
Away from the screen. Yeah. Thanks.
Bye-bye.